What's going on, everybody? So I have a very special video for you guys today, so please stay tuned. So as we all know, guys, trading is a very hard game. A trader who wants to win and remain successful in the stock market, you have to be extremely serious about your craft. So that's why today I will be sharing with you 3 most essential components of trading. So the first thing on our list is called psychology. As you guys already know, psychology is the study of the mind and behavior. In the stock market, the way you act and behave when you're in a position or before you enter a position is what determines if you're going to come out with a loss or a win. Which leads us to our first point, which is your success or failure as a trader depends on your emotions. You cannot allow your emotion to interfere with your trading, guys. You cannot let that happen. And our next, you cannot be too arrogant. That is one big thing that you cannot afford to have when you're trading. You cannot be too arrogant, because that can lead you sometimes to take some position size that your account cannot afford. Because in your head, you're thinking that you are too good for the market, and every position size that you take is going to be in your favor, which is not always the case in the market. Too upset, guys. So why did I put that under psychology? Well, the reason why I put that in there is because I feel like if you upset, you should never go into a trade, because that will only mess up with your mind and cause you to lose more. Because let's say that you got into a trade and you thought it was going to go your way, but it didn't, and you ended up losing a lot of money on that trade. And now your mind is all messed up and you upset because you thought that everything was in the right place, but the trade went bad. And you ended up going to another trade with a lot of emotions and forgot that you have to follow a system, and you didn't, and you got in onto another trade with a lot of shares, and then you ended up losing more. So going into another trade while you're upset is not a good idea. So our next most important components of trading is a logical trading system. So first we need to know what is a trading system. So a trading system is a set of rules or principles. When you're trading, you must base your trades on clearly defined rules. For example, a logical trading system is something that you can create yourself. You don't have to follow somebody else's trading system and hoping that that system will generate more profits to you. Sometimes it happens, but it's best if you create your own system that works for you the best. And so an example will be, some traders will buy a stock when the stock is trading at a strong support and sell it when the stock just break out of that support. And some trader will buy stock just when the stock is trading just a little bit over 200 days moving average and sell it when the stock break out. That is a system that you as a trader can follow, but it's up to you to choose if that's what you want to do. Some traders only trades when there is news and they buy right off the bat before the market opens and sell it after the stock goes up. This is all a few examples of a logical trading system, but it's a lot of them out there. So as you go and you're getting more experience and you trading more, you gain a lot of knowledge on how to create your own system and see what really works for you the best. So our last most essential components of trading is risk management. And I gotta say that if you guys cannot manage your money, you have no business of being in the stock market, guys. No business of being in the stock market. Because you must know how to structure your money so that whenever you took a loss, it's not a loss that can take you out of the game. Because your goal is to stay in the game as long as possible. And if you're trading very volatile stock and you're taking big position size, it will only take you a few days before you blow your account. And that happened to the best of us, to be honest, because we do not take risk management seriously. So for an example, if you have a $2,000 account, you don't go and buy into a stock that's already up 500% on a day. That's just not good risk management. Another example is, if you have a $2,000 account, you don't go all in on weekly options, because options, you can lose your money in just a second. And you have to remember that you in this game for the long terms. It doesn't matter if you are an investor or a day trader. You in it for the long term. You don't want to lose all the money that you put in on the same day. So you have to make sure that the position size that you're taking, if you take a loss on it, you're not gonna be out of the game on the same day. So that is it for this video, guys. So if you like this video and you think this video was helpful to you, please leave a like or comment if you have a questions, and subscribe because I will be making videos just like this for you guys. So thank you for watching, and please stay safe and have a great day. Thank you.